In February 1895, the United States Treasury held $41 million in gold. By law, it needed $100 million to back the currency. Panic withdrawals were draining $9 million a week. The nation was 3 weeks from insolvency. And the President of the United States turned to a single private banker. His name was John Pierpont Morgan. And the decision he made in the winter of 1895 didn't just rescue the federal government. It redefined the balance of power between private capital and sovereign nations for the next century. This is the story of how one banker financed an entire country. By 1895, J.P. Morgan controlled the most powerful private bank in America. His firm had reorganized bankrupt railroads, underwritten steel consolidations, and financed transatlantic cable systems. Morgan didn't lend to governments. He restructured industries. His capital came from both American depositors and European investors, giving him access to gold reserves no single government could match. What separated Morgan from other bankers wasn't just capital, it was credibility. When Morgan backed a bond issue, European investors bought it. When he restructured a railroad, its credit rating rose. He had become what economists would later call a reputational intermediary, a private actor whose endorsement carried more weight than a government guarantee. That credibility was about to be tested at the scale of a nation. The crisis had been building since 1893. A stock market crash triggered bank failures across the Midwest. Farmers and depositors, fearing currency devaluation, began redeeming paper dollars for gold at Treasury offices. This was legal under the gold standard, but it created a self-fulfilling panic. The more gold left the Treasury, the more people feared the dollar would collapse, so more people redeemed. President Grover Cleveland tried issuing public bonds to replenish the gold reserve. He issued $50 million in January 1894. It was redeemed within months. He issued $50 million more in November, gone by February 1895. The Treasury was caught in a doom loop. Every public bond sale signaled weakness, which accelerated withdrawals, which required another bond sale. By mid-February, the reserve had fallen below the psychological floor. Cleveland faced three options. First, abandon the gold standard entirely and let the dollar float, a move that would destroy American credit abroad and trigger mass inflation. Second, issue another public bond and hope it worked this time, despite 2 consecutive failures. Third, bypass the public market and arrange a private syndicate to inject gold directly in exchange for bonds sold at a negotiated price. That required a banker powerful enough to move markets. On February 7, 1895, Morgan received an urgent telegram from Washington. He boarded an overnight train from New York. By the morning of February 8th, he was in the White House. Also in the room, Treasury Secretary John Carlyle, Attorney General Richard Olney, and President Cleveland. The meeting was not publicly announced. The Treasury had $9 million in gold left. At the current drain rate, it would be gone in 6 days. Morgan made his offer. He would form a private syndicate, half American, half European, to deliver 3.5 million ounces of gold to the Treasury. In exchange, the government would issue $62 million in 30-year bonds at 4% interest, sold to the syndicate at a negotiated price below par. Morgan would personally guarantee that gold would not be withdrawn during the loan period. Cleveland hesitated. The optics were toxic. A Democratic president, elected on populist support, selling bonds to Wall Street at a private discount. Morgan invoked an obscure 1862 Civil War statute that allowed the Treasury to purchase coin or bullion at discretion. The law had not been used in 3 decades, but it gave Cleveland legal cover to bypass Congress. At 4:30 p.m. on February 8th, the deal was struck. The syndicate would deliver half the gold from European reserves, half from domestic sources. Morgan walked out of the White House, having committed his entire firm's capital and reputation to the survival of the United States dollar. From Cleveland's perspective, the decision was defensible. 2 public bond issues had failed. A third failure would trigger sovereign default and currency collapse. The private syndicate offered certainty, gold delivered immediately, and a contractual guarantee against further withdrawals. Yes, Morgan would profit, but the alternative was national bankruptcy. From Morgan's perspective, the risk was existential. If the deal failed, his European relationships would be destroyed and his firm's capital wiped out. But if it succeeded, He would become the indispensable financier to the most powerful economy on earth. The first shipment of gold arrived in New York on February 20th, 1895. Morgan's European partners had moved bullion from London and Paris. By March 1st, the Treasury's gold reserve had climbed back above $60 million. The panic stopped. Redemption slowed. The dollar stabilized. The syndicate had delivered exactly what it promised. The United States government remained solvent. The syndicate sold the bonds to public investors at par, earning an estimated $5 to $7 million in profit, equivalent to roughly $200 million today. The exact figure was never disclosed. Morgan himself likely earned $1 to $2 million. By the standards of sovereign bailouts, the fee was modest. By the standards of 1890s populist politics, it was obscene. The backlash was immediate. The deal established a precedent. Private capital could rescue sovereign governments, but only on private terms. Morgan had not acted as a lender of last resort. He had acted as a market maker of last resort, providing liquidity the government could not generate on its own. The distinction mattered. After 1895, Morgan's influence over U.S. economic policy became structural. When the Treasury needed to issue bonds, it consulted Morgan. When railroads needed restructuring, they hired Morgan. He had become a private central bank. But Morgan had no democratic mandate, no regulatory oversight, and no obligation to act in the public interest. His power derived entirely from his access to capital and his reputation among European investors. This created a paradox. The U.S. government was sovereign in law, but dependent on private finance in practice. The arrangement worked until it didn't. Other Wall Street banks watched the 1895 deal with envy and alarm. Morgan had cut them out entirely. The syndicate included only his closest allies, August Belmont, representing the Rothschilds, and a handful of European houses. Competitors like Kuhn Loeb had no seat at the table. The deal confirmed what many suspected. In a crisis, the U.S. government would turn to Morgan first. That expectation became self-reinforcing. Morgan's competitors couldn't match his access, so they couldn't build his credibility, so they couldn't win his access. Populist politicians and newspapers attacked Cleveland mercilessly. William Jennings Bryan called the deal a betrayal of the common man. Editorial cartoons depicted Morgan as an octopus, tentacles wrapped around the Capitol. Congress launched an investigation, but the investigation found no legal wrongdoing because the deal had been structured to comply with existing law. Morgan had won on both substance and procedure. The outrage changed nothing. The verdict is clear. The 1895 Syndicate saved the United States from sovereign default. Without Morgan's intervention, the gold standard would have collapsed, triggering mass bank failures and international credit loss. But the rescue came at a cost. It concentrated financial power in private hands, established a precedent for bailouts without public accountability, and entrenched Morgan as the de facto central banker of the United States, a role he would hold for another 12 years. After 1895, Morgan's influence only grew. In 1896, he arranged another gold syndicate when reserves dipped again. In 1901, he financed the creation of U.S. Steel, the world's first billion-dollar corporation. In 1907, when a financial panic threatened to collapse the banking system, it was Morgan, not the government, who organized the rescue, personally directing which banks would survive and which would fail. He had become the most powerful private citizen in America. But the 1907 panic revealed the limits of private power. Morgan was 70 years old, his health was failing, and there was no successor with his credibility. The crisis made clear that the United States needed a formal central bank, a public institution with the authority and resources to stabilize markets without relying on a single individual. In 1913, Congress passed the Federal Reserve Act. The age of Morgan was over. The Federal Reserve was designed explicitly to replace the role Morgan had played, lender of last resort, market stabilizer, and guardian of the currency. It had the legal authority to issue money, the balance sheet to move markets, and the democratic accountability Morgan had always lacked. But it also inherited the moral hazard Morgan had created, the expectation that large financial institutions would be rescued in a crisis. That expectation persists today. J.P. Morgan died in March 1913, just months before the Federal Reserve was created. His estate was valued at $68 million, enormous by the standards of the day, but far less than contemporaries had assumed. The bulk of his power had never been his own wealth. It had been his ability to mobilize other people's capital and his reputation for doing so prudently. That reputation died with him. No private banker since has wielded comparable influence over sovereign governments. But the precedent Morgan set in 1895, when Lehman Brothers collapsed in 2008, the U.S. government turned to private banks, Goldman Sachs, J.P. Morgan Chase, to execute the rescue. When European sovereign debt crises erupted in 2010, the European Central Bank relied on private bond markets to restore confidence. The mechanics have changed. The dynamic has not. Sovereign governments still depend on private capital in moments of crisis, and private capital still extracts a price. The lesson of 1895 is not that private bailouts are inherently good or bad. It's that they reveal a deeper truth about power. Credibility is a form of capital, and in a crisis, credibility can be more valuable than cash. Morgan saved the United States not because he had the most gold, but because markets believed he could deliver it. That belief was built over decades, through consistent behavior and strategic restraint. It could not be replicated overnight, and when it was finally replaced by a public institution, it took an act of Congress and a generation of political will. For modern decision-makers, the insight is this. In moments of systemic crisis, the actor with the most credibility, not the most resources, will set the terms. Morgan didn't finance the United States because he was the richest man in America. He financed it because he was the only man European investors trusted to deliver. That trust was his competitive advantage. And it was built not through marketing or lobbying, but through decades of keeping promises when others could not. Credibility is earned slowly, spent quickly, and in a crisis, it's the only currency that matters. This was the deciding move, the choice to bypass public markets and entrust the survival of the United States dollar to a private syndicate led by one man. It worked, but it also set a precedent that reshaped the relationship between Wall Street and Washington for the next century. Some decisions save institutions, some decisions transform them. The 1895 bailout did both. If this analysis added value, consider subscribing. We cover one critical decision per video. No biographies, no fluff. Just the move that mattered and why. Thanks for watching.